gold breaking above 4,610 and silver surging 7% to 85.53 per ounce. May look like the same story on the surface, but financially, these moves represent two very different signals. Gold's push to new highs is a classic hedge-driven move. It reflects sustained demand for protection as markets grapple with elevated debt, persistent policy uncertainty, and long-term confidence risks in currencies and sovereign balance sheets. Gold does not need explosive momentum to do its job. Steady accumulation at higher prices is enough. Silver, however, is behaving very differently. A 7% single-session move is not hedging behavior. It is performance capital rushing in. Silver is responding not just to gold's strength, but to leverage liquidity shifts and positioning that tends to emerge once confidence in the hedge trade turns into conviction about a broader monetary move. This divergence matters. Gold is leading calmly, confirming stress beneath the surface of the financial system, while silver is reacting violently, amplifying that signal through volatility. Historically, when gold grinds higher to new highs while silver accelerates sharply, markets are not pricing normal inflation. They are pricing instability and late-cycle pressure. The price difference tells the story. Gold above $4,610 signals preservation of value, while silver at $85.53 signals speculation, leverage, and urgency layered on top of that preservation. Understanding this distinction is critical because it explains why these metals can rise together, while sending very different messages about what comes next in the financial cycle. This strengthens the signal even further by observing the unique pace and structure of the movement between the two specific metals, uncovering the source of capital and why. Gold's climb above its April 2020 high of $4,610 has been methodical, supported by constant inflows from various institutions, central banks, and long-term, allocative investors who are not predominantly trading by momentum but rather managing risk in a more persistent and price-insensitive manner. This kind of buying tends to be persistent and unwavering, even in an environment where global debt levels remain high. Fiscal paths seem increasingly uncertain, and real yields continue to fluctuate without a clear directional stabilization. Gold benefits significantly from uncertainty itself, without the need for a specific outcome, as it primarily requires only the recognition that confidence is fragile. Conversely, silver's move to $85.53, by contrast, illustrates a very different mindset. A staggering 7% surge in a single session demonstrates crowded positioning breaking higher due to short covering and speculative capital rapidly accelerating once key levels are breached. This highlights the fact that, in contrast to gold, silver's smaller market size significantly magnifies these flows, turning initially incremental demand into highly outsized moves in price action. This unique aspect of the market plays a significant role in why silver often lags gold initially, and then moves quickly to catch up once conviction builds. Moreover, when considering the financial implications, this trend is critical because it tells us that the metals market is transitioning from a cautious hedging mindset that preoccupies financial actors to an active approach that explicitly expresses monetary stress. For gold, this represents the problem, while for silver, it highlights the heightened intensity of the movement as monetary stress becomes widespread. This provides the reader with an important insight. The market's perspective is no longer confined to just defending against the risks of a downturn, but is now placing increasing emphasis on understanding the unstable phase of the cycle that is becoming more prevalent. In conclusion, the distinct movements of gold and silver, while seemingly opposite in nature, offer a rich message. The first one highlights the robustness of its performance amidst uncertainty, while the second signifies the escalating intensity of this movement. Together they reveal that the metals market is no longer merely defending against risks. It is actively pricing the uncertainties of a potentially more volatile phase of the cycle. Another crucial distinction that becomes evident in this particular move is how each metal interacts in the broader financial system, particularly with varying aspects such as rates, currencies, and liquidity management. The strength of gold above the level of $4,610 is occurring without a direct collapse in yields or an immediate, outright panic in risk assets, which makes it exceptionally meaningful. This is not a flight that is entirely driven by fear. Instead, it appears to be a strategic reallocation of assets that is taking place even while markets are still functioning efficiently. This suggests gold is being accumulated as a core component of a balance sheet hedge, rather than being applied as a purely short-term trade. Investors appear to be prepared for scenarios where policy flexibility could potentially narrow, as well as remain elevated, and the value of confidence becomes increasingly important than the desire for return. Meanwhile, silver's dramatic surge to an approximately 85.53 level tells a different story altogether, since silver does not exhibit a passive absorption of capital. Instead, it reacts rapidly when markets start to question whether the existing framework can provide the necessary support. Silver is significantly more sensitive to liquidity conditions and the various forms of speculative leverage, and when it experiences such a sharp movement, it tends to mean that liquidity is rotating rather than expanding further. Traders and investors are actively reallocating the risk they are exposing, rather than taking it in a wholesale manner. This crucial distinction holds significant importance because it often appears at a late stage in the cycle. Gold tends to lead in recognizing the risks that are present but aren't quite fully expressed, while silver tends to move when those risks begin to have a significant impact on people's behavior, prompting changes to positioning as well as accelerating momentum. In general, this combination of events, where gold reaches new highs while silver dramatically accelerates, is often linked to instances where markets struggle to reconcile the ongoing growth, the presence of inflation, and the various policy constraints they face simultaneously. It doesn't provide a guarantee for a single outcome. However, it does highlight a heightened sense of instability being priced more openly in the market. The metals themselves are not just experiencing an increase. They are also communicating stress through a more structured and nuanced manner. Gold appears as a symbol of endurance, while silver portrays a sense of urgency. When these signals are collectively combined, the markets usually enter a stage where reactions become more rapid and the narratives shift more abruptly, leading to an extended exposure of both metals and broader risk assets to elevated levels of volatility. What investors should be paying close attention to next is whether the continued divergence between gold and silver persists or compresses, as it will significantly shape how the broader market interprets and responds to the movement. If gold continues to rise while silver remains highly volatile, it may indicate that the system is still in a transitional phase, characterized by an element of unease, but still not fully committed to a single predetermined outcome. In such an environment, gold serves as the anchor, effectively absorbing uncertainty without generating a demand for resolution, while silver undergoes a period of intense, oscillating movement as markets assess how far confidence can be expanded without causing a breakdown. However, if silver continues to maintain higher levels and this compressed volatility persists, rather than expands, it would signify something even more profound. Gold reinforces its role as the anchor during this change in the market dynamics. Historically, this transition usually occurs when investors have gained some understanding that monetary stress exists but are unsure about how to express it in a way that is more explicit and aggressive. Silver is the ideal vehicle for this expression, due to its significant leverage, with liquidity, its smaller market depth, and its dual function as both a monetary and industrial metal. This is also where risk management becomes increasingly critical. Silver's exceptional upside potential is accompanied by equally sharp reversals, especially when momentum-driven flows begin to dominate the price action. Gold, on the other hand, tends to maintain resilience even during silver's correction, reinforcing its role as the stabilizing force in the complex of metals. Financially, this situation creates a complex, layered signal. Gold communicates about the overall strength of structural confidence, while silver emphasizes the behavioral pressure felt by investors. When both these factors are significantly elevated, it suggests that the markets are not only attempting to hedge inflation or policy risks, but are also wrestling with uncertainty concerning the durability and sustainability of the entire financial framework in existence. This uncertainty is not easily resolved without the significant repricing across various assets, shifting correlations, and challenging historical assumptions that have seemingly served markets well under calmer and more stable conditions. The current price behavior is strongly suggesting that we are moving in closer proximity to that pivotal moment where the metals market no longer reacts directly to news events, but instead starts to react directly to systemic conditions and challenges that are present within the broader financial landscape. The broader lesson from this particular move is that precious metals are no longer operating in a context of isolation. Rather, they are exhibiting reactions to the very structure of the existing financial system. Gold surpassing the level of 4,620 represents a subtle indication that the market is gradually accepting a fact. Traditional anchors such as fiscal discipline, clear policy frameworks, and stable long-term currency stability are facing challenges. It is essentially a vote for the preservation of order in a world where establishing certainty is fast becoming an expensive endeavor. Simultaneously, silver prices surged by a remarkable 7% in a single trading session, reflecting the conditions that arise when that preservation attitude transforms into a palpable sense of urgency combined with leverage. In essence, this isn't about the manifestation of short-term excitement. Rather, it conveys how capital behavior evolves when confidence wanes and the range of alternatives becomes increasingly restricted. Gold and silver play distinct, yet complementary roles in the market. Gold serves as an efficient buffer to absorb stress, while silver further amplifies that reaction. When both of these precious metals start moving in a positive direction, particularly when silver accelerates and takes the lead, the marketplace is effectively communicating that there is no longer any sense of complacency surrounding the risk factor. Ultimately, the outcome of this continuing dynamic will depend on the degree of liquidity, prevailing interest rates, and the kind of policy action that evolves from this point. However, one thing certainly appears evident. These current price levels are not merely arbitrary. They are indicative of a complex system that is adapting and adjusting to the effects of pressure, where the need for protection and the pursuit of performance are no longer regarded as separate discussions. Instead, they are all part of the same ongoing, evolving cycle.